Hey there, bar exam candidates, and welcome to today's explainer. If you're gearing up to conquer the business analysis area of the exam, you are in the exact right place. Now, up until this point, you've probably spent a ton of time analyzing historical data, right? Staring at balance sheets and income statements, trying to figure out exactly what happened in the past. But today, we're making a massive conceptual shift. We're transitioning away from that historical, what happened yesterday data, and we're going to start predicting the future. We're going to learn how to use operational indicators to anticipate future financial results, and just as importantly, we'll learn exactly how to decode the customized, sometimes tricky narratives that management teams present to the public. Okay, here's our roadmap for today. We'll kick things off with leading non-financial measures, then explore the Balanced Scorecard, talk about benchmarking for context, decipher those non-GAAP measures, and finally, we'll wrap up by applying professional skepticism. Mastering this specific structure is exactly what the AI CPA blueprint demands. So let's get right to it. All right, Section 1, leading non-financial measures. If we want to understand where a company is actually heading tomorrow, we really have to look beyond the financial statements. So the absolute core concept you need to grasp here is the difference between lagging and leading indicators. Think of it like driving a car. Your financial statements, your income statement, your balance sheet, those are lagging indicators. They tell you the dollar outcomes of things that have already happened. Essentially, they're your rearview mirror. Non-financial measures, on the other hand, are leading indicators. They're your windshield. They are the operational performance indicators that actually drive tomorrow's dollar outcomes. If you want to know what profitability is going to look like next quarter, you don't look at last quarter's profit. Instead, you look at today's non-financial measures to see exactly which direction the business is moving. Now, the exam blueprint specifically calls out 4 focus areas, and you need to lock in on the distinct cause and effect logic for every single one of them. Let's break them down. First up, customer retention rate. Look, if a company's customer retention rate drops today, it mathematically guarantees that future marketing costs are going to have to rise to replace those lost customers. And what happens then? It inevitably squeezes your future profit margins. Next, we have employee turnover. Listen, this isn't just some soft HR metric. It is a blaring financial warning sign. High employee turnover today forces the company to incur much higher recruitment and training costs tomorrow. Plus, it severely drags down your overall operational efficiency while those new hires try to get up to speed. And that leads perfectly into our third metric, labor productivity rate. This basically measures how efficiently your workforce is turning inputs into outputs. If your labor productivity is high, your cost per unit drops, which means your future gross margins are absolutely going to expand. Finally, ticket response time. Picture an IT help desk or a customer service center. A slow ticket response time today means frustrated, angry customers, right? And frustrated customers lead to negative reviews, canceled subscriptions, and ultimately, future lost sales. The big takeaway here, every single one of these operational numbers signals a highly predictable future financial reality. Moving right along to Section 2, the Balanced Scorecard approach. Let's see exactly how these non-financial measures build into a cohesive, overarching strategy. This tool was designed specifically to cure management's very dangerous habit of getting tunnel vision on short-term profits. The Balanced Scorecard forces an organization to evaluate their performance across 4 linked perspectives, and it brilliantly illustrates the cause and effect chain of a successful business. It all starts right at the foundation, learning and growth. This is all about future capability, training your staff, fostering innovation, developing employee skills. Now, when you invest heavily in learning and growth, it directly improves the second perspective, internal processes. This one looks at operational efficiency. Because your staff is better trained, your production cycle times speed up, your defect rates plummet, and your cost per unit drops. Then, when your internal processes are highly efficient and you're creating flawless products, it naturally drives the third perspective, customer satisfaction. Customers get their orders on time, the quality is exceptional, and as a result, retention rates soar. And finally, when customers are totally delighted in sticking around, that ultimately dictates the fourth perspective, financial results. This is where the shareholders are finally rewarded with improved profitability, strong cash flow from operations, and overall revenue growth. It's a continuous, logical chain reaction. Let's actually look at how this plays out with a specific example. Suppose a company focuses its balanced scorecard on the customer perspective and sets a very specific non-financial target. Let's say they want to improve their customer retention rate from 75% up to 88% over the next fiscal year. To pull this off, they might launch an initiative to guarantee, say, 12-hour resolution times for any customer complaints. Well, if they actually hit that 88% retention target, the outcome is highly predictable. Retaining an existing customer is significantly cheaper than going out and acquiring a brand new one. Therefore, hitting that customer perspective target directly boosts repeat sales, it lowers customer acquisition costs, and it dramatically drives up the final financial perspective outcome, higher profit margins. The operational target dictates the financial reality. All right, Section 3, benchmarking for vital context. Knowing all these metrics is great, but a single number floating in a vacuum is pretty much useless. Benchmarking is exactly what gives your metrics context. And there are two distinct types you absolutely must know for the exam. First, there's internal benchmarking. This is when you're comparing departments, maybe different geographic locations, or different time periods within the exact same entity. This is incredibly useful for tracking your own historical progress, like finding out why your Texas branch is operating so much more efficiently than your Ohio branch. However, internal benchmarking has a major blind spot. It doesn't tell you what the rest of the world is doing. And that's where external benchmarking comes in. This is when you compare your company's performance against direct competitors or broader industry standards. Look, your internal benchmark might show that your sales grew by 5% this year, which, hey, sounds fantastic in isolation. But an external benchmark might reveal that the overall industry grew by 15%, meaning you are actually bleeding market share to your peers. See the difference? You absolutely need both internal and external context to get the full picture. Okay, Section 4, deciphering non-GAAP measures. We're going to pivot away from pure operational metrics now and shift our focus to management's customized financial narrative. Non-GAAP measures are, by definition, created by management. They are not defined or bound by generally accepted accounting principles. Management basically uses these alternative metrics to tell their specific story to analysts and investors, usually by stripping out items they consider to be unusual, non-cash, or just noise. They want to present what they like to call their core or normalized operations. But, and this is a huge but, you must remember as an analyst, and especially as an exam candidate, these numbers are completely unstandardized. That means management has a lot of leeway in how they calculate them. So here are the 4 common non-GAAP metrics you absolutely must be ready to define and analyze. First is EBITDA, earnings before interest, taxes, depreciation, and amortization. Management loves this metric. Why? Because it roughly approximates cash earnings from operations by ignoring the heavy non-cash drag of depreciation, as well as the effects of the company's unique capital and tax structure. Second is free cash flow. This is typically defined as cash from operations minus capital expenditures. It essentially tells investors how much actual cash is left over after the company is invested in maintaining or expanding its asset base. Third is core earnings. Now, this is a highly subjective metric where management strips out pretty much anything they deem outside their primary day-to-day business operations. And fourth is adjusted net income. This is where management takes standard net income and explicitly removes expenses they claim are non-recurring. We're talking things like structuring costs, stock compensation, or maybe sudden litigation settlements. But listen, management cannot just invent numbers out of thin air and publish them unchecked. I really need you to drill this hard rule into your mind for the exam. Whenever a public company touts a non-GAAP figure in their public filings or press releases, SEC rules dictate that they absolutely must provide a clear, quantitative reconciliation back to the closest comparable GAAP measure. This reconciliation is regulatory. It is not optional. It literally forces management to show their math, letting investors see exactly what was removed from the official accounting records to arrive at that customized narrative. Which brings us perfectly to Section 5, applying professional skepticism. Because management has to show their math, it allows us to apply the investor's ultimate defense mechanism, a recurring theme you have to carry into that exam room. Let's look at a concrete example to see exactly how this works in practice. Imagine we're analyzing a fictional company, let's call them Riverstone Tech. They publish their official financial statements, reporting a standard GAAP operating income of $80,000. But in their flashy investor presentation, the headline number they are vigorously promoting is an adjusted EBITDA of $120,000. I want you to immediately notice the massive gap management has created here. They are basically trying to convince the market that they are actually performing 50% better than what standard accounting rules say. When you see something like this, you must methodically walk through a gap analysis. Step 1, identify the gap. The difference between the GAAP number and the non-GAAP number here is $40,000. Step 2, look at that mandatory SEC reconciliation and ask what exactly is being added back. Well, let's say the reconciliation shows they added back $40,000 in what they call one-time legal costs and settlement fees. Step 3, this is where you apply your professional skepticism. You have to ask yourself, are these lawsuits actually a one-time event, or is Riverstone Tech operating in a highly litigious industry where they are constantly getting sued? Because a recurring one-time charge is not actually one-time, right? It's just a regular cost of doing business. Step 4, interpret the narrative. The reconciliation reveals exactly what management wants you to ignore. They are actively asking you to ignore their legal and compliance risks when valuing their performance. Now, keep in mind, actual exam questions will likely feature much larger, less perfectly rounded numbers, but applying this exact logic of isolating and questioning those one-time add-backs is exactly how you earn the points. To wrap this all together, I want you to memorize this 5-step thinking framework for analyzing literally any metric thrown at you on the BR exam. First, identify whether the measure is financial, non-financial, or non-GAAP. Second, determine exactly what it is trying to show or signal about the business. Third, find the vital context, either an internal or external benchmark or that required SEC reconciliation. Fourth, ruthlessly apply professional skepticism to any of those adjustments or claims. And fifth, make your final conclusion regarding what this actually means for the entity's future performance and risk profile. As you continue your exam prep, I want to leave you with this final provocative thought. Whether you are analyzing a soaring customer retention rate on a balanced scorecard or some heavily adjusted non-GAAP earnings figure, always ask yourself, what specific story is management trying to tell me here? And more importantly, what are they hoping I will ignore? Keep that skeptical, analytical mindset razor sharp, and you will absolutely conquer this area of the blueprint. Keep studying hard, and I'll see you in the next explainer.